My guest today is Michael Mauboussin, one of the world's leading experts in finance. Michael serves as Head of Consilient Research at Counterpoint Global, Morgan Stanley. He has authored 3 books and regularly appears in the Wall Street Journal, Financial Times, New York Times, and other publications. Since 1993, Michael has been an adjunct professor of finance at Columbia Business School and is also the chairman emeritus of the board of trustees at the Santa Fe Institute. In our conversation, we delve into the dynamics of markets, discuss all sorts of increasing returns, and explore topics such as Charles Darwin, policymaking, AI and Web3, and the Santa Fe Institute. I hope you enjoy our conversation. In this episode, we will dive into 2 interconnected topics that are central to understanding modern business dynamics. The first one is the subject of increasing returns, and the second one is the subject of scaling theory. But before that, let's start with a light touch. We are going to talk about some of the most brilliant scientists in history in today's conversation, which makes me want to ask the following. If you could have dinner with any 3 people, dead or alive, scientist or not, who would they be and why?
I love those questions, and I don't know, it's a hard one to do. First on my list probably would be actually Charles Darwin, who's probably my greatest scientific hero. I just actually last week put down rereading his autobiography, which is fascinating, which he wrote toward the end of his life. And what I admire about Darwin in particular was, I'm not sure he was the most brilliant, like a flashingly brilliant person, but he's extraordinarily methodical and extraordinarily dogged and extraordinarily open-minded in collecting evidence and even challenging his own views. So in many ways, and obviously the theory of evolution is so beautiful, it'll apply to a lot of things we'll talk about today. He'd probably be first. Number 2, I don't know, just the person who I would deem to be probably the most brilliant person of all time is Isaac Newton. I don't know if people communicate with Isaac Newton, but his contributions are just staggering. And you think about, over a period of 2 or 3 years, what he contributed to our scientific knowledge. So it'd be really cool. But I think I'm sure he was a quirky guy. So I'm not sure how fun that would be. And maybe the third one I picked was Aristotle. I think that, much of Western civilization is based on sort of these key Greek philosophers. And what I liked about Aristotle in particular is that, he was a pretty empirical guy, which appeals to me. And he had a lot of diverse interests. So I think he would be a very interesting guy to talk to. So I know that I could be talked out of any of these guys and be talked into other folks as well, but those would be the 3 I might mention.
I have to confess that Darwin is also my favorite scientist of all time and would also be on the table. So maybe we can share the same table. I will probably add Larry David, just for fun. But anyway, we can talk about who's going to be our guest. Moving on now to more serious topic, I suppose, the one of increasing returns. So I'd like to discuss that concept, which you define in a recent publication that will be linked in this episode's description as, and I quote, the case when a marginal investment generates an output above the average, end of quote. And you identify 5 types of increasing returns. The first one, economies of scale. Second one, international trade. Third, learning by doing. Fourth, positive feedback and network effects. And 5th, recombination of ideas. Now, all of these factors all contribute to the scaling of companies because obviously the more you benefit from increasing returns, the more you will scale. Please briefly unpack each of these types of increasing returns.
I should first start by saying that many of these ideas have been around for a long time. In fact, Adam Smith talked about these in The Wealth of Nations. But the way I organized that report was based on a wonderful book by David Warsh, which I would recommend to the listeners, called Knowledge and the Wealth of Nations. So I just want to give a shout out to Warsh and his work And he goes into these ideas much more depth than you and I will, even though what we're talking about is super fun. Economies of scale is simply the idea that as you get larger, you can do things at a lower cost. The classic from that was from Adam Smith's discussion of the pin factory. So even if you don't know anything about economics, you probably know about his book, The Wealth of Nations, and you probably have heard about the pin factory and the invisible hand. Those are the two most famous ideas. So this, again, allows, as companies get bigger, they can just do things cheaper. Classic theory. So and that, by the way, applies to all sorts of, whether it's a tangible based business or intangible based business, classic economies of scale. Trade is an interesting one. Paul Krugman, who's probably better known now as a columnist for the New York Times, but of course he won the Nobel Prize for his work on trade, international trade in particular. And, international trade really got going with, the main insight, the flash of insight was by David Ricardo and the concept of comparative advantage. And in fact, that area had been considered basically complete, like thought through. And Krugman came along about 45 years ago and added this other component where basically trying to solve this problem, how could similar countries, so say Germany and France, trade in such a way that would allow, both, again, the comparative advantage idea, but also introduce this specialization and the notion of increasing returns. So he worked out a model to show that when countries specialize in something, they can actually demonstrate increasing returns. The third one is learning by doing. This is a very intuitive idea, which is as you do something more, the costs go down. I think it's best documented by a concept called Wright's Law. Theodore Wright was a aircraft engineer, actually back in the 1920s and 1930s. And what Wright observed empirically was as you double the cumulative output for a product, the cost goes down by about 20%. And this Wright's Law has been an extraordinary regularity. In fact, when people tested cost curves, I think you had Doan Farmer as one of your guests before, when they tested about 60 different cost curves, they found that Wright's Law was as good, in some cases better, than Moore's Law in explaining the cost trajectories. Right. The fourth area is positive feedback and network effects. The network effect in particular is the idea is as more people use a good or service, the value of the good or service goes up. It's a little bit counter to your own intuition, right? If you like to go to the park on Saturday to enjoy it with your friends and family, having too many people there would make it less valuable an experience rather than a better experience. But network effects exist when more that increases the value. So what is the canonical example? Would be something like the telephone network, right? And I actually have a quote in one of my reports from AT&T's American Telephone and Telegraph's 1908 annual report, where they talk about network effects effectively, well over a century ago. And the fifth and final idea is the recombination of ideas. And I learned about this again from the Santa Fe Institute, but this idea that innovation effectively is the recombination of existing building blocks to solve a new problem. And so it's a very beautiful way of thinking about how we evolve, how technology evolves. The primary work there in economics was done by Paul Romer, who won the Nobel Prize for his work on endogenous growth theory. So how does growth come about? Classically, in economics, we talk about labor and capital working together to generate some sort of output. But empirically, it had been observed for a long time that output was greater than just the inputs would suggest. And so there was this other factor that hadn't been pinned down. And Romer came along and pinned down this other factor we'll call technology. But again, this idea of recombination of ideas being very central to that. So that's a quick run through of those 5 ideas. They're fascinating. Every business person, every investor, and ideally every citizen and policymaker should be aware of these ideas as they think about the world.
Yeah, thanks so much. It's more than a great overview. The report I enjoyed very much. It was the first time I could find all of those concepts, combined in such a nice way. Now, considering the strategy behind those increasing returns, because obviously it's, you could put the business in a way to benefit more or less from those increasing returns. Could you provide a couple examples of companies that have successfully transformed their business to take advantage of those increasing returns?
Absolutely. And first, let me just say, I'm going to mention some companies, but I don't want anybody to take these to be stock recommendations or anything like that. So this has nothing to do with investing and stock recommendations. This is not, so we're talking about the businesses themselves, but not the stocks. Learning by doing, I think a good example of that would be Tesla in the electric vehicle market. And we're also seeing it BYD in China, also in the electric vehicle market. So what we've seen is as these companies have been able to produce lots of vehicles and sort of at a speed faster than some of their competitors, they've been able to generate lower costs. And, looking at Tesla, for example, in the United States, it turns out that they are one of the most cost-effective producers of automobiles in the country, which is remarkable for a relatively young company. So that would be one example. You can look at other things as well. Solar panel manufacturing, also learning by doing, I think would be a key ingredient. On another one, I would just say it would be network effects, right? And, the classic example there, give a couple examples. With classic example there would be social media companies. So you think immediately something like Meta, which of course has Instagram and Facebook. And so if you want to hang out with your friends and Instagram's the main way you're communicating, that may be a very effective way to do that. And again, the value of it goes up. It was interesting that when Elon Musk took over Twitter, changed the name to X, there was a lot of concern and people said, let's go to alternative, social media sites. And there was a little bit of a move to doing that. And none of those really took hold, right? And so it's because it's such a very difficult coordination cost. So X remains sort of the main place for people to hang out. So there's an example of how hard it is to fend these things off. So those might be a couple examples when you look out into the world. And I think these companies do think about this quite overtly, but not always. So I think those would be good examples to illustrate those concepts of increasing returns.
Now I'd like to delve into the relationship between intangible assets and scale. And indeed, as you mentioned, some companies have that on top of their minds, but it's not because you do benefit from increasing returns that you will never be eventually competed out of the market. So on the one hand, we do know that the cost of distributing intangible assets, such as a software, they tend to approach zero, benefiting from strong economies of scales and sometimes network effects. Not for all the software, but it could be the case. On the other hand, intangible assets can quickly go out of fashion. They are easy to steal, and they are subject to recommendation, as we discussed already. Now, it seems to me that this tension often arises in antitrust cases, where one side would argue that increasing returns makes it very difficult to compete, while the other points to examples of past superstar firms that thrived on increasing returns, like AOL, MySpace, but eventually disappear. So in a sense, increasing returns does not mean illimited scaling. Now, given these two tendencies, how can we evaluate which side of the arguments hold more weight, whether in general or in specific cases? Or I guess to put it differently, is there any methodology that we can use to navigate these conflicting tendencies with intangible assets and assess how strong they are and will be in terms of creating barriers to entry the market?
It's a fascinating and deeply challenging question and very thoughtful question. Let me just mention one thing. There's a book that I very much enjoyed and learned a great deal from called Capitalism Without Capital. And the authors are Westlake and Haskell. And I would recommend that book. And in that, they talk about the strategic characteristics of intangible assets. And I'm going to play these back, but Thibaut is pretty much what you just said. So, but I'll organize them. And they use the 4 S's. It was kind of a cute thing. So 4 S's. The first S is scalability. This is exactly the point you just made, which is the incremental cost of distribution of many of these intangible assets moves asymptotically essentially towards zero, right? So if you have a great hit song or great software or even a recipe or formula, it can be distributed effectively costlessly. The second piece is they call it sunkenness, but I think the pre-concept is the notion of obsolescence, which is if my software is not the latest code, my song is no longer a hit, my formula has been superseded by a better formula, that asset becomes very worthless or close to approaching worthless. Now that's in contrast to a tangible asset, by the way, because let's say you open a coffee shop and you're very excited about it and you buy all the tables and chairs and an espresso machine and so forth. If it doesn't work out, those assets have some value. They may not be worth 100 cents on the dollar, but you can go off and sell them. By contrast, if you write software that nobody wants to buy, that is going to be effectively worth very little. So that really, I think, captures much of the tension that you just described. The third S they talk about is spillovers. And this is also very important to acknowledge, is it's very difficult to protect intangible capital, right? There are things like patents and trademarks and so forth, but in reality, we know that those things are difficult to deal with. So how quickly do best practices spill over to other organizations? And then the last one, they talk about synergies, which is exactly the idea we were talking about with, recombination of ideas. So that how does innovation happen? So, going back to this, I don't know the answer to your question. I mean, I think that this is the tension that you really want to think through. There's a very interesting framework, though, I think sort of illustrates this. And that's it's a thesis came out of the book by Jim Besson at Boston University, who wrote a book called The New Goliaths. And Besson sort of documents this point that large technology companies have been spending large sums on proprietary software. And that's the key. It's proprietary software. So it's not being sold to the world. That's allowing them to both benefit from economies of scale, sort of again, traditionally defined, but also to do customization or personalization in a way that was really, really impossible before. Now, of course, companies have always innovated. They've always developed intellectual property internally. But the point that Besson makes, I think, is really compelling is that in the past, those ideas diffused to other companies, right? This goes back to the spillover. They spilled over to other companies. And to a large degree, he's claiming that is less true today. And so they're able to capture and sustain advantages because they're not sharing. The spillovers are not happening in the way they did before. So he gave an example of General Motors developed the automatic transmission for cars back in 1940. And, and there were patents and all that, but within 10 years, and obviously a world war in the middle, but within 10 years, it was diffused to every original equipment manufacturer, right? So this is, you're exactly right. It's thinking about these two things. And the fact is, though, once a company does become deeply established and it's a relatively large market, it seems to be difficult to see how to unseat them. I will mention in the report, and I'm glad you're going to link to it. We have a chart showing how Google emerged to be the leading company in search. And, now when you look back on it 25 years later, it seems like a foregone conclusion, but people should go back and examine that chart more carefully, because what you see is in the early days of search, there were wild market share changes. By the way, Google didn't even exist, but wild market share changes. And it was very, very uncertain as to which company was going to take over, was going to emerge as the standard. And I'll just mention that, my firm at the time in 2004, so 20 years ago, when Google went public, we did an analysis and we're going to participate in the initial public offering. But it was very much a topic of what if two other guys come along in a garage and create, Google Plus, right? And put Google out of business, just as Google put everybody else out of business. So even 20 years ago, it wasn't, for us at least, a foregone conclusion that they would dominate. So I think that tension you've described is perfectly stated, and I think that's the key thing to focus on. And then, that when you're valuing companies as an investor, of course, then you're saying, how much am I paying for the sustainability of the current position, right? You may or may not be paying for that sustainability, but you've put your finger on the key issues.
And so to add a bit of complexity, or to put it differently, to make it a bit more complicated, let's consider how policymakers could actually approach and use the concept of increasing return. And let's have a look at generative AI or blockchain, where you do see that some companies are actually not just investing in proprietary software, but also in open source as a strategic way, right? Potentially to make it a commodity and to cut the grass on your neighbor's garden. So what do you think policymakers can do with increasing returns when we are now talking about entire ecosystem where you see that technology is coming from all over? And actually, well, the graph for research, maybe you want to add Perplexity and you want to add ChatGPT, because to some degree there are some some relationships or some sort of pressure put by those, not directly substitute product. So I'll make it short. I'm a policymaker. I work for US Congress. Is there any use of increasing return, or is it just too complicated for me to use?
Well, Thibaut, you're the expert in this topic, not me. So I should be asking you that question. But the way I might approach this question would be by using the framework of Clay Christensen, formerly of Harvard Business School, on disruptive innovation. Right. And so he would say that innovation comes along, the first type of innovation, sustaining innovation. Right. And the innovation itself can be radical, it can be dramatic. But the key is that these incumbents can integrate it while essentially maintaining their current business model. A disruptive innovation, again, can be radical and so forth, but the key is that it is a new business model altogether. So it's a new way of doing business.
Yeah.
And I think the question we have to ask now about AI, and specifically generative AI, is, does it feel like it's more a sustaining innovation? In other words, the big companies can just integrate it into what they're doing to make them be better at what they do? Or is there a role for disruptive innovation where new companies can come along and develop new technologies? So I think that remains to be seen based on some of what how the stock market seems to be voting today. And by the way, that can obviously change. It feels like the stock market is voting such as it is more sustaining than disruptive, but time will tell. Now, whether we see something completely different come along, I think also remains to be seen. You probably read or know Chris Dixon's new book, Read, Write, Own, where he talks about a new kind of network that's essentially based on blockchain technology, where it's not controlled by corporations, where the economic spoils to the degree to which they're developed by that network are shared more equally with the creators and so forth. That it's a very interesting idea. I don't think it's gotten a lot of traction just yet. And I guess the last thing I'll finish with is when we think about increasing returns, and obviously, in the United States, I'm sure it's true in other parts of the world, but certainly in the United States, there's a long history of antitrust, and trust busting was certainly about more than a century ago was a big deal. But the question you always ask is, have you gotten to high returns on capital, or have you enjoyed increasing returns for, in quotes, reasonable reasons, like because you're good at what you do or you've attracted a certain customers, or are you doing it in some way that's illicit or stepping on the toes of others or impeding competition in some important way that's illegal? And that's, I think, a very, very thorny issue to resolve. I think it's just a thorny issue to resolve. But so I don't know the answer to your question. I think it's an excellent question. I think that there's a book called Digital Empires by Anu Bradford, who's a professor of law at Columbia University. And, she talks about different regulatory environments. It's a fairly simple and straightforward framework. But that's another thing to sprinkle into this, because the motivations of politicians around the world, whether it's the EU or the United States or China, their motivations might be slightly different. And so that also we could throw into the mix in terms of how policymakers will think about what they do to either encourage or discourage a competition.
So far, I'm happy to report that I score pretty high on the scoreboard of all the books you've been mentioning, and it may be that some of those people will be guests on the podcast eventually. But let me indeed change shoes, and so we are not policymakers anymore. Let's say that we are investors. Random idea, right? And let's look at whether increasing returns could be helpful for those investors. Just a side note, when Google first presented, at the time it wasn't called Gemini. I forgot the name they gave to their Gen AI application, but that day, because of a bug, or at least that's what the press said, the market valuation of Google decreased by a couple billion US dollars. And I'm not sure if this was because of a bug. My interpretation was that it could be that Google that day showed the willingness to cannibalize its own business model with the 10 blue links and instead do something different, which is to provide just one answer. So long story short, my question will be the following. It seems to me that increasing returns could have some importance to policymakers. We've been talking about that. It may be that, for example, you enforce competition law and you want to target practices by companies that decrease your competitors' ability to benefit from increasing returns. I would argue this is a good way of going about it. But now, moving on to the investor world, and especially in the Silicon Valley, we do see that often they seek to invest in businesses that benefit from strong increasing returns due to the winner-takes-all tendency. But as you explain, well, you can also go out of fashion very, very quickly. So my question is this: how do you specifically incorporate the concept of increasing return in your day-to-day work?
Yeah, so I mean, the companies that our firm likes to identify and ultimately own are businesses we would think are unique with an ability to generate sustainable excess returns, or returns on invested capital over the cost of capital over time. So that's the first thing. Is this a good business that can generate good growth, attractive returns, and do that for a long period of time? So to your point, that uniqueness is measuring moat and sustainability of the moat and so forth. That's one aspect of it. The second aspect is just, as I alluded to a few moments ago, is the question is, does the market get it, right? Because it's not just finding good businesses or avoiding bad businesses. It's asking what is priced into the stock. So it's really the combination of those two things. When you're looking for a mispricing, you want a business that has expectations or modest relative to the ultimate prospects of the business. So I think that's the high level way of thinking about this. And, there are many other considerations, but the notion of increasing returns certainly is something that comes into the story many, many different ways.
On that, let me take a step back and now move on to part two of the conversation, where we look at the trends and the output, right? What's coming out of all of those increasing returns we see out there, especially in the digital economy. In your paper or your report, you mentioned several of the world's top economists, including Paul Romer, Alfred Marshall, Brian Arthur, Adam Smith, Keen Arrow, and a couple others. Okay, now this is a very impressive group, and yet much research remains to be done to fully understand market dynamics. What concrete research do you think is urgently needed in this space that these very distinguished economists either left out or have not yet addressed?
It's a fascinating question. And interestingly, if you go back and read Alfred Marshall, he explicitly says that economics is very biological in nature. So he was very aware of these ideas of evolution and so forth. But the field took a turn. And I think the field started to take a turn in the late 1800s towards being more mathematical. And, people talk a lot about this concept of physics envy. And I think that was really a thing. And perhaps the most formalized, the formalization of that happened a lot under Paul Samuelson, who arguably was the most influential economist in the 20th century, who really turned to mathematical methods to express many of the ideas. By the way, I'll just say as a side note, Ken Arrow, who was absolutely brilliant, of course, he also was a Nobel Prize winner, was one of the originators of the Santa Fe Institute. So his Nobel Prize was for work in equilibrium. Interestingly, I believe his most cited paper is on learning by doing, interestingly. And he one time came to the Santa Fe Institute, and I thought it was quite fascinating. He sort of said, I almost rue the day that I sort of went down this path and formalized mathematically much of what we were doing in economics, because he acknowledged from the very beginning that what he was doing was almost sort of this Platonic ideal versus really capturing what's in the real world. Now, by the way, I've never had a problem with this, even like the University of Chicago, efficient markets and so forth. I mean, people have these reactions to it. My reaction is always, this gives us a benchmark. It's a touchstone from which we can examine reality and see how far it departs, again, from this ideal world. And so if you just understand it as an ideal world, so it's not explaining how the world really is, but explaining how the world could be or should be, perhaps, I think it's okay. What could we be doing what could economics be doing, broadly speaking? I think you know the answer to this because you interviewed one of the guests one of the scholars doing a lot of great work on this. I think because of the computational power we have today and the data that we have today, we should be moving much more toward agent-based frameworks to understand the world. And so, Doan Farmer, one of your guests, in his recent book called Making Sense of Chaos, I think is one of the best single articulations of the power of using agent-based models. And what's wonderful about that is, A, we can calibrate parameters so as to come up with outputs that appear to be, at least resonant with what we see in the real world. But allowing us to simulate the world many, many different times opens up our imagination to the way things might happen. And this is a thing, of course, as human beings, we understand the future is pulsating with possibility, but we somehow, when we look backwards, everything is what we see is what has happened, and we forget about the counterfactuals. We're not very good at counterfactual thinking.
So on that idea of agent-based modeling, it seems to me that one space where you may want to indeed deploy an ABM is to better understand market concentration. And in fact, in a recent report, you stated, and I quote, "Many investors have a sense that concentration is too high because it has risen sharply from a much lower level, but perhaps we should ask whether concentration was too low before." Why is that?
First, just to make sure all the listeners are all on the same page, this is concentration. We mean what percent of the U.S. stock market is comprised of the top 10 companies. That number at the end of 2023 was 27%. So 10 companies were 27% of the market. About a decade ago, that was about half of that, 13 or 14%. And you really had to go back to the 1960s to get something that approached that. By the way, that was year-end 2023. As of sort of now, or these most recent days, it's actually over 30%. So it's actually gone up a bit. So when you think about what is the appropriate amount of concentration, it's very much to your point. What it means is the large companies have done well. And we want to ask the question, two questions. One is, was it wrong before and is it right today? By the way, I think investors probably less settled by the absolute number and more unsettled by the rate of change, as I mentioned, doubling over a decade. And then the second question we want to ask is, do the fundamentals justify what we see today? In other words, is there economic substantiation for what we're seeing? So, yeah, the way we looked at the first question was maybe it was too low before, as we said, let's just take the 2023, ending stock prices. And again, the largest companies would be familiar to all the listeners. It would be Apple and Microsoft and Google and those types of businesses. And we said, well, what if they were correctly priced at the end of 2023? And then we went back 5 years or went back 10 years and said, pretend that they were priced back then in such a way that they would earn a market rate of return, right? So they would be higher because they generate substantial excess returns in reality. And when you do those calculations, you see that concentration, by definition, would have been much higher before. The second thing we can ask is, has the world changed in such a way that the economic profit justifies what we see? And just to give you one quick snapshot on that, at the end of 2023, again, the top 10 companies were 27% of the market capitalization, but they were nearly 70% of the economic profit. And this is not profit by itself, it's economic profit, which is taking into consideration things like the opportunity cost to capital. And if you actually go back over time, it is quite consistent that the economic profit contribution is greater than the market concentration level. So it's a very interesting question. And I always ask these kinds of questions when people say this used to be this and now it's this. And the question is always, not always, is it wrong today? Was it right before, right? And I think people are not used to that mindset of thinking about the counterfactual. Perhaps it was wrong before and it's right today. Although, again, you could argue that it's wrong today and it was right before.
Yeah, of course. And again, coming from antitrust, this is the kind of discussion we are not having, or at least not publicly, right? Especially with the new guidelines or directives coming up when it comes to market concentration and merger control. So again, an avenue for research maybe. I do have to ask such a stupid trivia question, but based on your background and your experience and what you just mentioned, I was thinking, well, Nvidia was obviously part of the top 10 at the end of 2023, and far from it if we just looked at the company 5 years ago. So my stupid question would be this: what is the worst investment advice you've ever heard? And how would it translate in today's world with AI and, as you mentioned, blockchain, Web3, and all of those new technologies?
My reaction to that is and again, all this depends on what strategy you're pursuing, but the advice I never thought made much sense was, in the investment business, you want to be right or try to be right more than 50% of the time. Now, it's very intuitive to say, well, if I'm right more than half the time, that's going to work out. But it turns out in investing, it's not how often you're right, but how much money you make when you're right versus how much money you lose when you're wrong. And, one example of that is venture capital. And these data, of course, are very well understood that, for every 100 venture capital investments, broadly speaking, and there have been studies of tens of thousands of these types of investments, roughly 50 to 60% lose money, and a relatively small percent make a little bit of money, and then just a very, very, very small percent generate almost all the economic returns for that industry. So it's not uncommon that when we introduce a new technology, whether that's, for example, launching the internet or now, of course, artificial intelligence, that there's a period of experimentation where people don't really know what's going to work. And it's commonly the case that, again, many investments like options end up being not very valuable, but a few things end up doing very, very well. So to me, that would be the one argument, is to say, if you look at a lot of different types of markets, by the way, even in public markets in the United States, it's an astounding statistic, but since 1926, of all the public companies that have ever existed, 60%, almost 60%, have failed to earn returns equal to treasury bills. The vast majority of companies, I'm exaggerating, the majority of companies have not earned good returns. And the top 2% of all companies have generated basically 90% of the wealth for markets over time. So again, it's not how often you're right, it's how much money you make you're right versus how much money you lose when you're wrong.
Yeah. And so even in that answer, I sense that your views, whether on investments or market dynamics, are strongly influenced by complexity economics. I guess the first sub-question here would be whether or not it's a fair assessment. And if so, how did you first encounter complexity, and how come you think this is such a compelling idea that years after you encountered complexity, you're still in the mood of learning more about what's going on in the space?
So I was introduced to the idea by Bill Miller, who years later ended up being my boss and my colleague. And Bill Miller was the former chairman of the Santa Fe Institute and had been one of the largest supporters of the Institute over a long period of time. In the mid-1990s, so this is now approaching basically 30 years, Bill said, you should really go out there. By the way, at the time, I was doing a lot of reading, especially in the area of biology, especially in the area of evolutionary theory. I was very excited about many of those ideas. And so I went out there and I was immediately enthralled. It was just extraordinary. And part of it is, as you can imagine, the intellectual ideas, but a large part of it is the Institute tends to attract people who are just voracious, open ideas and interests. So that was sort of my introduction. And in particular, there were two areas that I saw the immediate application. The first is what we've been talking about today, which is increasing returns, right? I minored in economics in college, but I took my microeconomics class and was taught like everybody else. And by the way, as a very, very good default assumption, it is true that incremental returns migrated toward the cost of capital, and competition and senescence assured that to be the case. Still a very good default assumption, by the way, for many businesses. The second thing, though, I learned at the Institute was thinking about markets themselves as complex adaptive systems. And, the classic way to think about markets is sort of these rational agents going around with perfect information and understanding of their own preferences. And that allows them to trade in such a way that we get to essentially prices that are efficient, even informationally, certainly informationally efficient, even allocatively efficient. And of course, that had nothing to do with the real world. And, as soon as markets opened, we saw booms and busts that classic theory struggled to reflect. It turns out that I think thinking about the market as a complex adaptive system achieves two things simultaneously that are very powerful. One, it shows why markets can be efficient and why it's so difficult for investors to do better than the market itself. And second, allows us to understand why markets periodically go crazy, right? Why the wisdom of crowds and the madness of crowds can both exist within the same framework. And I found that to be extraordinarily powerful and sets up conditions to understand why market efficiency may be constrained. So yeah, that would be my Santa Fe Institute. And so I got involved shortly thereafter, late 1990s, joined the board in 2001, was chairman of the board for more than 8 years. It's been an extraordinary source, not just for the ideas, but also for the people that tend to go there.
Is there any good story you'd like to share regarding your time at the Santa Fe Institute? Some fun memories, something that will stood out eventually?
I don't know. Two things come to mind. First, I should mention that we talked about Charles Darwin at the top of our conversation, and we had a meeting in London, and the current president, David Krakauer, and I decided to do a little day trip out to Down House where Darwin lived. And so David and I hung out there, and we walked the paths of the great Darwin. And David's a biologist by training, sort of mathematical biologist by training. So it was a real thrill for us to do that. I would just say the first time I actually went out there, again, this is probably 1995 or 1996. I actually didn't look at the weather forecast very carefully. Santa Fe, if you've never been there, by the way, it's even northern New Mexico has got a very special environment, right? It's very creative, lots of art, lots of science, obviously Los Alamos, not far away. And so I went to bed. The meeting was the next day, and I woke up, and there was like 10 inches of beautiful powdered snow. Unanticipated. I was wearing the wrong shoes, but it was one of those, the sky was perfectly clear and blue, and it was really sunny. And I shuffled in my work shoes to the conference and just remember such a special feeling, not just from sort of what the weather itself, the pristine snow, the beauty of the sun, the beauty of the sky, and then going in there and just being intoxicated by the idea. So, that's quite an introduction, is when you have this incredible setup, and it was off and running from there.
Yeah, indeed. I must say that I actually also read the autobiography of Darwin, and something that, when I'm reminded of the book, particularly stands out is his relationship with his dad. I found that to be very emotional and beautiful. That makes me think, do you think of complexity outside of your work, like on your day-to-day life? Or is it something that you just try to put for complexity economics and then live by other standards?
Oh, no. Oh, no. There's no way to do that. There's no way. Once the genie is out of the bottle, it's not going back in. Yeah. No, I'm very interested in things like complex adaptive systems. I'm very interested in things like evolution. I'm very interested in things on, cognitive psychology and psychology, broadly speaking. And I think once you are versed in some of those core ideas, it is absolutely impossible to walk around the world and not see how they apply in all sorts of different situations. So it's really a way of thinking about the world, I think, that goes vastly beyond markets. I'll just mention, especially for those listeners who are interested in markets or investing, probably the greatest embodiment of this was Charlie Munger, who's best known as being Warren Buffett's partner at Berkshire Hathaway. Mm-hmm. But Munger was this extraordinarily well-read, very thoughtful, very brilliant man, but was just a wonderful case study in how he applied all this learning and all this great way of thinking to basically every single thing that he did. And I think it's almost inevitable if you go down this path.
Yeah. Okay, let me ask you a final question. And you mentioned psychology. I will here be a bit controversial, and I will quote Freud and more specifically is a general introduction to psychoanalysis. I don't know if you've read the book, but something that I remember quite vividly is that at the end of each chapter, Freud will tell you, well, this is what, because it's convenient, you will remember for the chapter, but this is what you will forget, but I want you to remember. And so here's my question. What's the one takeaway you hope listeners will remember? Not the one that they will take out, but the one that you hope they will take out of this conversation today.
Yeah, it would probably be to be intellectually open and to be disciplined in taking ideas from all different fields to allow you to think better. But the key thing is being open. And you mentioned Darwin's relationship with his father, and I agree. Your assessment, I think, is exactly right. And it was quite interesting. And his father is a very different person than he was. But toward the end of the autobiography, he's got a section where he says, every time I see something that contradicts my own view, I write it down without hesitation and, without waiting to make sure that I think it through, so that when my theory was sort of laid out, there was very little anybody could have said that I wouldn't have thought of, because I actually went through all those things myself. So I also love that discipline of making sure that you're not only willing to listen to things that conflict with your own views or perhaps what facts you believe, but you're sort of documenting them, and you're essentially immunizing yourself from confirmation bias.
Yeah, and again, knowing where it's coming from, being this very young little boy, just walking around and collecting flowers and insects and just doing it for the sake of it, to then becoming so methodological, I think tells a lot about his character. And indeed, there is a lot we can learn from it. I think it's a perfect way to end the conversation. Michael, thank you so very much for your work, for the conversation today. It's a pleasure reading your reports, following you on Twitter or X, and I very much look forward to see what's coming next. And on that note, to everyone out there, take care of yourself, and if you can, someone else too. Bye-bye.